the commissioner moved in and said, no, this is all marketing activity right in New Zealand. Therefore, nothing to do with connection to the property in Fiji. So it's a marketing of timeshare. So again, it becomes tricky as to how you draw the connection to the property. That is something that how the courts will interpret in India is an issue as to how they draw connection to the property. India also has got a pretty large offshoring type activity, whether people will try to claim that the work is done in relation to a foreign company, whether you can avoid the output tax, the tax that you put on yourself, the 10% and the 10%, 20%, because it becomes a cost for the overseas company and you might lose your advantage with this sort of tax. So very similar to the example that I gave in relation to the marketing activity for a timeshare company, where the tax was, the activity was deemed to be happening in New Zealand and not connected to the property. So India, of course, if you it depends. That's a similar connection. But if you are able to demonstrate that it is an export sale, if you're in Australia, if it's an export-related sale, of course, there's an exemption anyway. So one has to balance that whether you can treat your services as an export or it's happening in such a way that you're offering your service in such a way that you have to charge the 20% tax. Of course, a foreign-based company cannot claim the input tax credit because it's out of the jurisdiction. So that's something that you might like to consider. Imports traditionally have created a bit of problem for smaller operators. Maybe in India there may be small industries, cottage industries that buy imported. I don't know to what extent, but some countries, the smaller operators, still able to import small quantities of goods on which they pay import duties. A registered entity for GST would be able to claim the duty and then pass the benefit of that, particularly then if it later becomes an export, sometimes it becomes an export as well. So there is a issue about benefit from tax credit for maybe small operators. Again, it all comes back to you being registered, being able to entitled to claim your input tax, the GST paid credit. Another area that in Australia there was problem was the GST legislation came into force. It kicked on 1st of July 2000. Before that there was a sales tax regime, so companies had paid 17.5%, 20%, 25% sales tax on goods. There was a transitional regime where they were able to offset that, but then it kicked in, they were holding stock. That is something that may have to be fine-tuned for India's circumstances, but there was a problem in relation to inventories that were held after the cut-off date. Intellectual property in Australia is another area where there may be scope for the lawyers to do something about because the payment in regard to intellectual property from to an overseas organization or business enterprise would normally attract GST. So I also talked about rulings. So there are rulings I've already spoken about. extent, the current system with there was this very similar system as far as the central government is concerned. I suppose your system may be ready with the abolition of the old taxes and the new taxes. Might require to look at the pricing and things like that for your clients, modify your processes, improve your processes. Accounting system may have to be upgraded, and of course there is a risk with the new tax, with every purchase and every sales being subject to GST. That is another area that creates a bit of a risk. Not only that, you may be entitled to some claims. You have already retained some sales as a paid tax on it. If you are then that sales becomes bad debts. Must have system in place to cope with that so that you can claim your GST back for the sales, the tax that you paid at the sales which has gone bad. Australia's system also had certain system of how you pay the tax. I haven't gone into that in my paper, but there's a cash-based system. There's a and particularly in relation to the bigger businesses that have the taxes paid by on the invoice basis rather than a cash basis. So they have to have all these issues in place. So as far as the lawyers are concerned, this area is quite a grey area. There will be opportunities for lawyers. So in my conclusion, I would say that since the businesses are already subject to some form of a GST type system, your system should be such, not as challenging as when the tax was introduced in Australia or New Zealand. Those are my comments.
Thank you very much. And I must add that I couldn't thank you enough, because the issues that you have raised, I could see India bracing all of those and more, considering the fact that today the way services are taxed is pretty much in line with what internationally services are taxed. So 2012, India introduced what we call the supply of services rules, place of provision of services rules, point of taxation rules, etc. And given the fact that we have such a wide country with so many states and businesses spread across all the region, some of the nuances that Mr. Kumar spoke is something that we will actually grapple with. How to tax intangibles, whether it is software, whether it is patent transfer, how do we tax multi-jurisdiction transaction where the asset could be in India, the beneficiary could be in Fiji, and the recipient, the person who is actually paying for it, could be sitting in London. So there are many such issues, and I'm very grateful to you that you have brought out many of those issues that Australia has faced. It's not enough for us to, in today's discussion, settle all of them. I guess it will take some time before we actually digest that. The paper is available with the organizer. Anybody wants to have a copy of that, feel free to ask for it. May I now request Krishnan Malhotra to make his propositions.
Thank you, Ghosh. Good afternoon to everyone. Transfer pricing, as we in short say TP, and probably I always say that TP actually stands for transfer pricing, but the way people have been facing the problem, it appears to be as if it's a tearful pains. And in last 9-10 years, when it was introduced by the government way back in 2001, it was thought that with a very right intention. Initially, few years were good. Maybe the people were not fully educated. The department was not fully aware of. But then thereafter, we found that year after year, it became so painful exercise that nobody understood that the transfer pricing is a subject of economist. It is not something which you can measure being a tax officer. as you would have heard, the Vodafone, the judgment which has just been pronounced by the Bombay High Court, and then we have a latest judgment on same grounds by Shell, where they touched upon the transfer pricing. Although the Vodafone has really been a buzz name, for last so many years, and we have seen so many amendments which have taken place just because of the Vodafone, the judgment. But as far as transfer pricing is concerned, I thought it is very relevant to see how that good judgment is, so that you should be aware of where the judiciary is taking us to. And now we will have to see how the government reacts to this particular, judgment. Just to share the facts with you on this judgment is that here there was a Vodafone subsidiary which they wanted to expand their, the capital by using the methods prescribed under the Control Act. They found the value of the share of rupees 10, and they came to the conclusion that the value of the share is 8,519, and accordingly 246 crore was brought into the country by way of subscription of shares, and it was contributed by the holding company. Very simple fact, it's in a capital receipt. You wanted to bring in the capital, and certainly they found that the value of the share is higher. They found the method which is prescribed and computed the value of the share, brought in the value along with the premium. That is what a very plain vanilla transaction. Somehow the income tax authority said that the value which you have computed based on Control Act, it should not have been the same, but you should have found the NAV value, and they found their own way to computing the same and said the value should have been 5 times higher than what you have computed. And accordingly, they said the difference between what you brought in by way of premium is 1,300 crores based on the valuation, which they believe is the right way of computing it, and the difference should be treated as a transfer pricing adjustment. That is one. Secondly, they said since you did not bring this money into the country, it would be considered as subsidiary has granted a loan to the holding company. And since it is in a loan, 13.5% is the usual rate right now. You should have charged this money, this interest on that loan, notional income. And so they said 88 crores should have been the interest, which should have been levied on the holding company, and it should have been recovered by the subsidiary. So combining the two, somewhere around 1,400 crore adjustment was made by the transfer pricing officer. That's what the facts is. These adjustments are known as secondary adjustments. These are not the direct adjustments because there is no direct transaction. Everything you are doing notionally, you are presuming, and then you are making the additions. That's where the facts are. The writ was filed. The High Court gave a direction to look into all the aspects of this case just to see whether it is an income or not. Because you are bringing a capital. Tomorrow there is an IPO. You apply for a share, and would the money received by the company would be treated as an income? It is the price of the share which you need to compute that. So effectively they said, if there is no income, whether this transaction would fall under the transfer pricing regulation or not. Because international transaction is defined in the law. There is a separate, chapter, transfer pricing regulation within Income Tax Act, and which is considered as a separate, the code. Income tax officer said that the TPO officer concluded by saying the definition of international transaction include capital financing. So you are financing a company and you are restructuring your business, because both these words do appear in international transaction. On a safer side, since the company had a transaction with their holding company, which is a related party, they did mention this transaction in the transfer pricing report, only out of abundant caution, and gave a remark that since it does not contain any element of income, we do not need to do any arm's length pricing in this matter. However, we are reflecting only for the sake of information. So the way the authorities treasured it by treating this as a transfer pricing transaction, treating it as an international transaction, shortfall was computed without it is being received, treated as income, and which is not received presumed to be as a loan given, again further presumed that you should have charged interest at the rate of 13.5%, and this is how they made an adjustment to the tune of 1400 crores and computed the huge tax demand for which the writ was filed. In spite of directions given by the High Court, DRP again concluded that this is a fit case for transfer pricing adjustment. Once this case was held to be within the jurisdiction of transfer pricing, again the writ was filed in the court. The court heard the thing very carefully and they came out with very interesting findings, which I thought there are different aspects to this. So it is important to go through. So what are the notable, the findings which they conclude? They said the basic concept is it is income arising out of international transaction is the first condition. It is an international transaction, but it is not within the definition of international transaction. You are not financing the company. It is an issue of a share capital. No doubt you are enriching the company, but it is not financing where you are giving a loan. It is not a loan transaction. It's not a borrowing transaction. You are becoming one of the owners by way of shareholders. It is not a restructuring. You wanted to expand your business, you will go back to your shareholders and shareholders will give their contribution. So in which way? So they said, if shares are issued at premium, will premium be considered as a revenue item? And if you people are aware of, if you look into the balance sheet, premium appears separately, which under the company's law have a separate rules and regulation where and how you can use this money. So said, is receiving a premium is an income? That was the first question which they very clearly say that there is no specific section